All right, welcome to today's explainer. Many people hear the term fixed income and they just assume the price of a bond is, well, fixed. I mean, it's right there in the name, right? But honestly, that is absolutely the number one mistake beginners make. Everyone thinks bonds are sleepy and boring, but today we're going to completely demystify the financial iron law and show you the core mechanics driving trillions of dollars around the globe every single day. So, does fixed income actually mean a fixed price? Nope, not at all. It's a massive trap. Here is the reality. In the eyes of a Wall Street trader, bond prices are fluctuating every single second of the trading day, exactly like stocks do. The fixed part of fixed income doesn't actually refer to the price you pay today. What is fixed is the contract itself. The contract promises a fixed schedule of payments in the future. The actual market price of that contract today, however, is a constantly moving target. And that brings us to the physical level law of the bond market. Because those payouts are locked in by contract, the bond's current price and its yield have a strict, unbreakable inverse relationship. It is literally a financial seesaw. Bond price and yield always move in opposite directions. When the price goes down, the yield simply must go up. Today, let's break down the logic behind this seesaw. Let's completely strip away the institutional jargon for a second. Imagine you hold an IOU from me, promising to pay you exactly $100 1 year from today. Now, let's look at scenario A. You decide to sell that IOU to me for $95. So I pay $95 out of my pocket today, and next year, I get the $100. I make a solid $5 profit, which gives me a yield of roughly 5.2%. Pretty straightforward, right? But now let's look at scenario B. Let's say you are absolutely desperate for cash right now, and you agree to sell me that exact same IOU for just $80. Look what happens to my profit. I pay $80 today, but I still get that guaranteed $100 next year. My profit just jumped to $20. And a $20 profit on an $80 upfront investment, my yield is now a massive 25%. Think about that. The future payment of $100 never changed. It was always fixed, but simply because I bought it at a much lower price, I mathematically earned a much higher yield. Price went down, yield went up. That is the core of the seesaw in action. Now, we don't just rely on intuition in finance. We need indisputable mathematical proof. So why is this relationship unbreakable? Just take a look at the bond pricing formula. I know, formulas can look a little intimidating at first glance, but this is the actual engine under the hood of the entire global fixed income market. Let's break down exactly what this equation is telling us. Let's take a slow look at the key players here. P is simply the current market price. That's what you'd pay to buy the bond right now. CF represents the future cash flows. Remember our $100 IOU? That's your cash flow. In the real bond market, these are the coupon interest payments and the final return of your principal. And here is the absolute secret. These are permanently locked in by the contract. Y is the yield, basically your average annual return. And T, that's just the number of time periods until you get paid. Okay, so here is the logic. In this equation, Y, the yield, is sitting right there in the denominator. Since the future cash flows in the numerator are legally fixed by the contract, whenever the yield Y increases, dividing by a larger number mathematically forces the overall price P to decrease, just to balance the equation. It's pure arithmetic. If the market suddenly demands a higher yield, the price simply has to drop. So how does this actually play out in the real world? Well, this perfectly explains why the bond market absolutely crashes when the Federal Reserve raises interest rates. Step 1, the Fed aggressively hikes rates. Step 2, suddenly, new bonds are paying out higher interest, so the entire market demands a higher yield, our Y variable. Step 3, what happens to all those old bonds stuck paying tiny 1% or 2% fixed rates? They become totally unattractive. Their prices, our P variable, must drop significantly until their effective yield matches the new higher market rates. If you want to think like a pro, just remember this. In finance, you are essentially buying future cash flows. The less you pay today, the more you earn tomorrow. Whenever financial news is screaming about rising yields, instantly picture that seesaw taking a hit on prices. Master that seesaw, and honestly, you've mastered the heartbeat of the bond market. Now, applying these concepts in real markets involves defaults and liquidity risks, which we didn't model today. This explainer is for financial education purposes only and does not constitute investment advice. But I will leave you with this final thought. If the Federal Reserve suddenly decides to aggressively cut interest rates next month, how exactly will your portfolio react to the other side of that seesaw? Keep questioning how the numbers work, and I'll catch you next time.